10 basic financial formulas. Learn these to avoid losing your money. The financial world can be incredibly scary for the uninitiated. For those just getting their feet wet, there are a lot of acronyms and numbers thrown your way. This makes it pretty easy to get lost in the weeds with all of these financial formulas floating around. That's okay, though. You don't have to understand every single formula to be successful with your personal finance. There are some fundamental formulas that you need to know in order to be successful when managing your money. The trick is knowing where to look and which ones you should master first. Here are 10 of the most critical formulas you should know as soon as possible if you want to take control of your money sooner rather than later. 1. How to determine your cash flow. Calculating your cash flow is one of the simplest formulas. It all comes down to how much you bring in and how much you spend. If you have a negative balance at the end of this formula, you should reevaluate your finances. Here is the formula for calculating cash flow. Income, expenses equals cash flow. 2. How to determine your net worth. Simply put, your personal net worth is what you own, minus what you owe. In other words, what remains of your assets after you take out liabilities. Again, a positive balance is desired here. There are some who have net worth in the billions, but it doesn't mean you should be discouraged about yours. Knowing your net worth is a good way to motivate you to make more money. Here is the formula for calculating net worth. Assets, debts equals net worth. 3. Simple interest calculation. When calculating the interest charged on a loan, simple interest is used. It's also known as principal interest because the interest is calculated solely on the principal amount. Interest is calculated using the following formula. I equals Px or Xt. The breakdown. I equals interest. P equals principal amount. R equals annual interest rate, as a decimal number. T equals the length of time the money is borrowed or invested for, in years. 4. Compound interest calculation. Compound interest is the calculation of compounded interest rather than just the interest earned on the principal invested or borrowed. It can also be defined as interest on savings calculated on both the initial principal and the accumulated interest from previous periods. This is the formula to use. P, 1 plus Rn, Nt equals A. A equals the amount earned after deducting interest. P equals the principal amount. R equals annual interest rate, as a decimal. N equals the number of times interest has been compounded, per year. T equals the length of time the money is borrowed or invested for, in years. 5. How to determine the price to earnings ratio. If you're looking at stocks or companies, use this formula to calculate the relationship between a company's share price and per share earnings. This can tell you whether stocks are overpriced or underpriced. Here is how it is calculated. Price to earnings ratio equals share price, earnings per share. 6. Calculating the break-even point. Knowing when you've reached break-even is critical to running a successful business. Use this formula to determine when you'll finally break even, or if you've already done so. Fixed expenses, gross profit margin equals break-even point, in dollars, in percentage. 7. How to determine net income. Here's a quick way to calculate your company's net income. Revenue minus expenses equals net income. 8. How to calculate investment variation. Calculating the variation of your investment reveals what has happened to your investment over time. Has it risen, or has it fallen? The result, expressed as a decimal ratio, tells you how much more, or less, your purchase is worth. Variation in purchase price equals current price, purchase price, purchase price. 9. The rule of 72. The rule of 72 is a useful trick that tells you how many years it will take for your investment to double in value at a given annual return rate. Simply put, how long will it take to double your investment? The same formula can also be used to calculate how long it will take you to double your debt. Proceed with caution. Years required to double your investment equals 72, compound interest rate, per year. So for $100 invested at 8% interest per annum, you will need 9 years to double it. 10. What is your basic liquidity ratio? The basic liquidity ratio indicates how long, in months, a family can cover their expenses with the assets they have. When the breadwinner is no longer able to bring in money, this is useful for personal finance, which can sometimes happen for a varying amount of reasons. In the case of businesses, it is used to determine how long a company can survive on its current assets if necessary. Here's how it's done. Monetary assets, in dollars. Monthly expenses equals basic liquidity ratio, in dollars. Conclusion. It's not news that doing our own finances can be extremely confusing. But when it comes to basic financial formulas, not knowing them can cause problems. A bit of knowledge goes a long way in helping us save money and get ahead of the game. So if you're looking to improve your financial literacy, understanding some basic financial formulas is an important step. The good news is that these formulas aren't as daunting as they might seem at first glance. It's simply a matter of learning a few key concepts and making a few basic calculations.